Hey everyone, and welcome to This Explainer. Today, we're totally decoding the complex and, let's be honest, sometimes super secretive world of mutual funds, ETFs, and the hidden math of investment fees. Seriously, if you've ever looked at your account and wondered where your portfolio returns are actually going, or why two seemingly identical funds perform so differently over time, well, you are in the exact right place. We're going to figure it out together.
Okay, let's dive into this. We have a great roadmap today. We'll start by building your investment foundation, then compare mutual funds and ETFs. After that, we'll tackle the hidden cost of fees, look at some common risks and performance illusions, and wrap it all up with practical tools for smart investors.
Right, let's kick things off with Section 1, building your investment foundation. Because before we even think about picking specific funds, we absolutely must understand the core strategy of managing risk. So the crucial starting point here is asset allocation. Think of this as the deliberate process of dividing your investments among different asset categories, like stocks, bonds, and cash. It is definitely not a guessing game. It's entirely based on two really critical personal factors. First, your investing time frame, meaning when do you actually need this money? And second, your risk tolerance, which is your psychological and, financial ability to endure market swings without panicking. Getting this right is literally the bedrock of your entire investment journey. And this perfectly ties into a classic saying we've all heard since we were kids, right? Don't put all your eggs in one basket. This is the pure essence of diversification. By spreading your money out across different asset classes or even different sectors within a single asset class, you significantly reduce your overall risk. Think of it like a financial shock absorber. If one specific company or sector takes a massive hit, the others might hold steady or even grow, protecting your whole portfolio.
That brings us directly to Section 2, mutual funds and ETFs. Now that we know we need to diversify, let's look at the actual vehicles we use to get that diversification efficiently.
So there are some pretty stark mechanical differences in how you actually buy and sell these two popular vehicles. Take mutual funds. They're priced just once a day at their end-of-day net asset value, or NAV. That's essentially their daily price tag. You can trade them in exact specific dollar amounts. So say you want to invest exactly $500 a month, you can do that, which makes them incredibly easy to automate for things like retirement savings. On the flip side, we have ETFs, or exchange-traded funds. These trade intraday, exactly like individual stocks. However, you generally have to trade them in full shares, and depending on your platform, you might be subject to brokerage commissions and bid-ask spreads. Now, within those vehicles, you're going to encounter two completely distinct management philosophies. On one side, you have actively managed funds. These rely on human managers doing heavy research, buying and selling frequently to try and beat a market benchmark. And, well, because of this hands-on, high-effort approach, they naturally carry higher costs. On the other side, we have index funds. These use a much more passive, automated strategy, designed simply to track a market index like the S&P 500. There's less trading, no expensive research analysts, and generally that means much lower overall costs to you as the shareholder. Which leads us perfectly into Section 3, and frankly, the core conflict of this entire explainer, the hidden cost of fees, because exactly how a fund is managed directly dictates what it costs to own. It's really worth stopping and asking ourselves, what are we actually paying for our mutual funds? It is so incredibly easy to ignore fees because, let's face it, you never sit down and write a physical check for them. They're just silently deducted from your daily returns. But wow, even a seemingly tiny 1 or 2% fee drastically reduces your compounding wealth over a long-term investment horizon. Fees are basically the silent killers of portfolio growth. To protect yourself, we have to break down this absolute alphabet soup of charges. They generally fall into two broad categories: annual operating expenses and shareholder fees. Annual operating expenses are the recurring costs of running the fund. This includes management fees paid to the advisor and those pesky 12b-1 marketing fees. Shareholder fees, on the other hand, are highly transactional. You pay them directly out of pocket when you buy, sell, or exchange your shares. So where do you actually find these numbers? Well, when you pull up an SE standardized prospectus fee table, look right under the annual fund operating expenses block. You will clearly see the management fees and those 12b-1 distribution fees. And get this, those 12b-1 fees actually go toward the fund's own advertising costs. No way, right? But yes, add these together and you get your total annual fund operating expenses, which is often simply called the expense ratio. Now let's see how this builds into the second part of the fee table, the shareholder fees section. Notice the term sales load. This is essentially a massive commission that directly compensates the broker who sold you the fund. Below that, you might see a redemption fee, which is basically a penalty paid when you sell your shares back to the fund. These fees are a big deal because they directly eat into your starting capital or your final payout. Let's clarify how these loads are actually applied. A front-end load is deducted immediately upon purchase. So, say you invest $10,000 with a 5% front-end load. $500 is instantly taken out to pay the broker. Only $9,500 actually gets invested and starts working for you. A back-end load is a fee paid upon selling. But actually, there's a catch here. It typically declines to zero the longer you hold the fund. It's explicitly designed to incentivize you to keep your money locked into the fund for years. When we actually run the math on how different share classes impact your bottom line, the results are completely fascinating. Take Class A. It hits you with a painful 4% upfront fee, but has zero ongoing 12b1 fee. Class B, meanwhile, has no upfront fee, making it look super attractive at first glance, but it charges an ongoing 0.5% 12b1 fee every single year. After 1 year or even 4 years, Class B often looks like the winner, but stretch that out to a 10-year horizon. Class A's painful upfront fee actually beats Class B's ongoing 12b1 bleed. It's wild. This just proves why you absolutely have to match your fund's fee structure to your specific investing timeframe. Let's push forward to Section 4, Risks and Performance Illusions. Because trust me, hidden fees are not the only traps you're going to encounter in fund marketing materials. When you see an advertisement boasting massive returns, you have to stop and ask, how reliable is that performance claim really? Watch out for things like cherry picking, where a fund purposefully only highlights periods of extraordinary returns while completely hiding their brutal down years. Then there's backtesting. This is where they apply hypothetical, newly invented algorithms to past markets to show how a strategy might have performed if it existed back then. It is not actual historical data. And definitely beware of benchmark mismatches, like where a specialized tech fund compares its returns to a broad, conservative index just to look artificially superior. The most crucial point to remember is captured perfectly in this standard federally required disclosure you'll see everywhere. Past performance cannot predict how an investment strategy will perform in the future. Historical success is really just a measure of past volatility and specific past economic conditions. It is absolutely not a crystal ball for your future returns. All right, let's wrap this up with Section 5, Tools for Smart Investors. Because understanding the traps is only half the battle, right? Now we need to equip you with the exact tools to navigate this landscape safely. Here is your clear, actionable, 3-step checklist to execute before you commit a single dollar to a new fund. Step 1, pull up the fund's prospectus online and go straight to that fee table we discussed. Step 2, explicitly ask your investment professional how they are being compensated for recommending this specific fund to you. Don't be shy about it. And Step 3, run the math on the total costs over your expected holding period. And for that third step, honestly, there is no better resource than the FINRA Fund Analyzer. This is a remarkably powerful, completely free tool provided by the Financial Industry Regulatory Authority. Think of it as your absolute secret weapon. You can instantly filter and compare over 30,000 mutual funds and ETFs. And most importantly, it actually projects the future value of your investment, net of all those tricky loads and 12b1 fees, over your specific holding period. It literally does all the incredibly complex math for you. So I want to leave you with this final, provocative thought to consider today. Does your fund's strategy actually fit your long-term investment goals? Or are you unknowingly just paying for their marketing and your broker's commission? I highly, highly encourage you to log into your accounts, find the prospectus for your largest holdings, and take back control of your portfolio's performance. Thanks so much for joining me for this explainer, and as always, keep learning.